Long before bank failures, stock crashes, and modern recessions, the merchants of Japan lived with a different kind of uncertainty. A fire could erase a shop in one night. A failed harvest could distort prices across an entire region. A trade route could close, a regulation could change, or a powerful customer could disappear without warning. Wealth was never assumed to be permanent, and yet, some merchant families survived for generations. They did not survive because they could predict every disaster. They survived because they organized their lives around a harder truth. Collapse does not announce itself before it arrives. Their greatest protection was not a secret investment, but a disciplined way of thinking. They preserved cash, kept records, spread risk, protected reputation, trained heirs, and treated prosperity as a temporary season rather than a permanent identity. To understand how they prepared for financial collapse, we must first understand what they believed wealth was for. During the Edo period, Japan enjoyed long stretches of political stability. Cities expanded, markets deepened, and merchant houses grew in major commercial centers. But wooden cities remained vulnerable to fire, while floods, poor harvests, debt, changing rules, and volatile prices could destroy years of work. Public luxury could attract resentment, and one generation of weak judgment could damage a family name built over decades. So the strongest merchant houses learned to separate wealth from appearance. To them, money was not proof of superiority. It was stored resilience. This was the principle at the center of their preparation. Protect the house before expanding the house. The house meant more than a building. It meant the family, the business, the employees, the records, the reputation, and the capital that allowed all of them to continue. Growth mattered, but continuity mattered more. A merchant who chased profit without protecting the foundation was considered dangerous. Profits were not automatically converted into a more expensive lifestyle. Reserves were maintained, accounts were reviewed, and decisions were judged not only by what they might earn, but by what they might endanger. The question was not simply, how much can this opportunity make? It was also, what happens to us if it fails? That second question is an ancient form of intelligent risk management. It worked because merchants understood something behavioral economics would explain centuries later. Human beings become careless during periods of comfort. When income rises, spending often rises with it. When prices climb, optimism begins to feel like evidence. When business is good, debt appears less threatening. People stop imagining loss precisely when they can most afford to prepare for it. Prosperity creates an illusion. It makes temporary conditions feel permanent. A successful season encouraged expansion. Expansion increased fixed costs. Higher fixed costs reduced flexibility. When trade weakened, the real threat was not simply lower income. It was the lifestyle and obligations built during better years. This is why disciplined merchant families resisted what we now call lifestyle inflation. They understood that every permanent expense quietly makes a claim on future income. A larger residence, lavish ceremonies, expensive clothing, unnecessary borrowing, each decision reduced the distance between stability and crisis. Minimalism, in this context, was financial defense. The less a household needed, the more calmly it could respond to hardship. But reserves alone were not enough. Merchants also relied on information. Detailed ledgers protected them because numbers exposed problems before pride was ready to admit them. A merchant who tracked inventory, debts, payments, and expenses could see weakness forming. One who relied on impressions might feel prosperous while quietly becoming insolvent. Many people experience financial collapse first as confusion. They do not know what they owe, spend, or how long their savings would last. The crisis appears sudden, but the vulnerability was building in the dark. A ledger turns vague fear into visible reality, and visible reality can be managed. The hidden psychology was humility. To keep records is to admit that memory is unreliable. To hold cash is to admit that opportunities may disappear. To avoid excessive debt is to admit that the future may not cooperate. To train the next generation is to admit that personal success does not guarantee family continuity. Humility made the merchants harder to surprise. They also understood the value of reputation. In a world with limited formal protection, trust functioned like capital. A merchant known for fair dealing, disciplined repayment, and calm behavior during difficulty gained more than profit. During a crisis, reputation could influence who continued trading and who remained loyal. Their view of wealth was broader than money. Financial resilience also depended on relationships, reliability, useful skills, and the ability to remain valuable when conditions changed. Merchant houses also practiced a form of diversification. A business depending on one customer, one product, one route, or one source of credit was exposed. Stronger houses widened their relationships and activities so that one failure would not destroy the whole structure. But they did not confuse diversification with disorder. Adding 10 things you do not understand does not reduce risk. It may only hide it. True diversification means refusing to let a single point of failure control your future. For a modern household, that may mean building an emergency reserve, developing more than one valuable skill, avoiding one fragile income source, using appropriate insurance, and investing across time rather than betting everything on one dramatic outcome. It also means understanding opportunity cost. Every dollar used to impress someone cannot also strengthen your reserve. Every hour spent chasing short-term excitement cannot also deepen a skill. Every debt payment created by unnecessary consumption reduces the capital available for long-term investment. The merchants understood that wealth is shaped by rejected decisions. What they refused to buy helped preserve what they could later build. This is where samurai discipline and merchant discipline quietly meet. The samurai trained for control under pressure. The merchant needed the same control, but his battlefield was uncertainty. He had to resist panic when prices moved, greed when profits rose, shame when contraction became necessary, and pride when success invited display. Financial collapse is rarely caused by one emotion. It is often caused by a sequence: optimism, expansion, denial, fear, and desperation. Discipline interrupts that sequence early. Today, the mistakes look modern, but follow the same pattern. People use rising income to justify rising obligations. They mistake access to credit for strength. They invest without reserves, leaving themselves forced to sell during hardship. They assume a secure salary cannot disappear. They build a lifestyle that requires uninterrupted success. Then a job loss, recession, family emergency, or business decline arrives. The event feels like the cause, but often it only reveals the design. The Japanese merchants prepared by designing for survival before survival became necessary. A modern version of their method begins with 4 questions. How long could your household continue if income stopped today? Which expenses protect your life and which merely protect an image? Where is your single point of failure? And what should be strengthened during good years? The answers may be a reserve, a useful skill, a trustworthy network, a diversified long-term portfolio, lower fixed expenses, or better records. Preparation is not pessimism. Pessimism assumes disaster makes effort meaningless. Preparation assumes uncertainty makes discipline valuable. The Edo merchant did not hide from commerce. He traded, invested, negotiated, and expanded. But he tried to make sure one bad season would not erase every good one. That is the deeper purpose of wealth preservation. It is not the fear of losing money. It is the refusal to let one moment control the rest of your life. Compound wealth needs time. Time requires survival. And survival requires margins between income and expenses, assets and debt, confidence and reality. The families that endured were not always those that earned the most in one year. They were often those that remained standing long enough for discipline to compound. Financial collapse is not defeated by predicting the exact day it will come. It is defeated quietly, years earlier, through the expenses you never accepted, the reserves you refused to spend, the risks you chose to understand, the records you kept, the skills you strengthened, and the patience to let wealth grow without needing it to be seen. The merchant who prepared for winter did not waste summer fearing the cold. He simply remembered that seasons change, and because he remembered, he was still there when prosperity returned.